Well, the AI-powered party for Ethereum is officially over, and the hangover is just starting to kick in. That massive price crash you just saw, that was the sound of the bubble bursting, but what most people don't realize is that the AI hype was just a convenient cover for some major, fundamental weaknesses in Ethereum. Today, we're going to expose those weaknesses and look at the on-chain data that points to even more pain ahead. By the end of this, you'll understand exactly why this crash happened and what the smart money is getting ready for. Let's not beat around the bush, the numbers here are staggering. Just a few months ago, in August 2025, Ethereum was riding high, trading near its all-time peak of almost $5,000. Fast forward to today, mid-February 2026, and it's struggling to hold the line around the $2,000 mark. That's a catastrophic drop of approximately 60%, wiping out billions in value and leaving a trail of liquidations in its wake. But this wasn't just some random market dip or a healthy correction. This was the violent unwinding of a narrative that was never sustainable, and it was fueled by a perfect storm of factors. To really get what happened, we need to break it down. First, and maybe most importantly, was the huge macroeconomic headwind. For months, crypto investors clung to the idea that assets like Ethereum could decouple from traditional markets and serve as a hedge against inflation. The last few months have completely shattered that illusion. With weak US employment data, rising layoffs, and persistent recession fears, institutional money fled from anything considered risk-on. Investors piled into safer assets, and Ethereum, instead of being a safe haven, traded just like a high-risk tech stock. The digital gold story flipped on its head as investors preferred actual gold, and Ethereum was treated like any other speculative tech play. The second driver, and the one that really defined the 2020 now, was the evaporation of the AI bubble. Last year, the crypto world was obsessed with AI-integrated projects, from decentralized computing to on-chain AI agents, as the main platform for many of these ventures. Ethereum basically became a bet on the entire AI crypto story, but that hype had an expiration date. When big tech companies like Microsoft and Google started facing tough questions about the real-world returns on their massive AI spending, a wave of AI fatigue hit the stock market. That feeling quickly spread to crypto, and Ethereum, which had been the biggest winner from the AI hype, became its biggest victim when the bubble popped. But the shaky global economy and the fading AI hype, that's only half the story. To understand why this crash was so brutal and so fast, we have to look at the cracks that were already forming in Ethereum's own foundation, cracks that the AI hype conveniently papered over. The first and most explosive issue was the leverage wipeout. The run-up in 2025 was fueled by an insane amount of borrowed money. Traders were using high leverage to bet that prices would just keep going up. But when the market turned, it triggered a catastrophic cascade of liquidations. We saw a prolonged period of stress where leveraged long positions were gradually wiped out over several days. This wasn't just selling, this was a forced death spiral. The liquidations pushed the price down, which triggered more liquidations, and the cycle repeated. It was a brutal reminder that leverage is a double-edged sword. Adding fuel to the fire was the shifting sentiment around institutional products. After all the initial excitement about spot ETFs, the tide started to turn. We started seeing significant outflows from major funds, with some weeks showing hundreds of millions of dollars being pulled out. This spooked the market because it showed that the smart money, which was supposed to create a stable price floor, was now adding to the selling pressure. The idea that institutions would prop up prices forever was proven wrong. They're just participants, not guardians, and their money can leave just as fast as it came in. Finally, there were growing worries about Ethereum's core development. The story around Layer 2 scaling solutions, which are meant to fix Ethereum's high fees and congestion, started to sound less convincing. Even Ethereum's co-founder, Vitalik Buterin, admitted that progress on the next scaling stages was slower than hoped. At the same time, rumors of austerity measures within the Ethereum Foundation itself began to swirl, and whether true or not, they created a sense of doubt among even long-term believers. If you're finding this deep dive analysis valuable and you want to stay ahead of the market, do me a quick favor and hit that like button. It tells YouTube you want more of this kind of data-driven content, and it really helps out the channel. So, what does all this mean for the price of Ethereum right now? This is where we need to look at the charts and on-chain data, and honestly, it's not looking pretty. From a technical standpoint, Ethereum is in a really precarious spot. It's currently trapped in a tight trading range, roughly between $1,900 and $2,200. That $2,100 area has become a massive wall of resistance that it has failed to break through again and again. Every time it tries to rally, it gets sold off, which shows that the bears are firmly in control. Key momentum indicators like the Relative Strength Index, RSI, are stuck below 50, signaling that bearish momentum is in charge. This brings us to the downside targets. If Ethereum can't hold its current support around the $1,900 to $2,000 level, the technical charts point to more pain. The first stop would likely be a retest of the recent crash lows, somewhere in the $1,760 to $1,820 range. If that floor gives way, there's very little support until you get to the $1,600 $1,700 zone. Some of the more bearish models even suggest a potential drop to $1,400 or lower if we see a full-blown capitulation. Prediction markets are reflecting this grim outlook, with many traders betting on another drop before any real recovery. On top of these technical risks are the regulatory headwinds that continue to hang over the entire crypto market. Key legislation like the Clarity Act, which is supposed to create clear rules for the industry, has faced delays. This uncertainty makes it tough for larger, more conservative institutions to jump in, and until we get a clear green light from regulators, the market might keep trading at a regulatory discount. En denders percursel. Now, it's easy to be a pessimist when everything's in the red, but it's essential to keep a long-term perspective. While the short-term picture looks painful, most institutional analysts aren't calling for a repeat of the 2018-style crypto winter. Many see this as a necessary, if brutal, correction after things got too hot, and they're already eyeing the catalysts on the horizon that could pave the way for a powerful recovery. The first and most important catalyst comes from inside the network itself. Ethereum is in the middle of its most ambitious upgrade cycle ever. Developers are preparing for major forks in 2026, with names like Glamsterdam and Hegeda being planned. These upgrades are designed to implement features like parallel transaction processing and massively boost the network's capacity, potentially increasing transaction speeds by orders of magnitude while cutting fees. This isn't just a small patch, it's a fundamental re-architecting of the blockchain to get ready for the next wave of global adoption. The second catalyst is the quiet return of institutions. While the short-term ETF flows have been negative, the bigger picture shows that long-term, large-scale players see this downturn as a buying opportunity. Big money players continue to accumulate a significant percentage of the total ETH supply, seeing the current fear in the market as their entry point. The digital oil thesis, the idea that ETH is a productive, yield-bearing asset that powers a digital economy, is gaining serious traction in institutional circles. They aren't buying the hype, they are investing in the infrastructure. Finally, there's the element of market cycles. Historically, crypto's major bull runs have peaked 12 to 18 months after a Bitcoin halving, which puts us right in the window for a potential new leg up. If the current recession fears die down and the Federal Reserve starts signaling easier monetary policy, a flood of liquidity could pour back into the market. In that kind of environment, risk assets like Ethereum could stage a dramatic recovery, and the price targets from these bullish analysts are staggering. Even conservative models see Ethereum bouncing back to the $3,000 to $4,000 range by the end of the year. But many base case scenarios are targeting $5,000 to $7,500. Some outliers from major banks like Standard Chartered have even put out long-term projections, calling for $7,500 by the end of 2026 and potentially $12,000 or more in the following years as the tokenization of real-world assets accelerates. So, what's the bottom line here? The Ethereum bubble, which was pumped up by unsustainable AI hype, has definitely burst. That triggered a 60% crash, exposing deep weaknesses in market leverage and showing just how tied Ethereum still is to macroeconomic fears. The road ahead looks treacherous in the short term, with technicals pointing to a high chance of more pain and key support levels that need to be watched like a hawk. However, the long-term story is a battle between two powerful forces: short-term pain versus long-term potential. On one side, you have fear, deleveraging, and economic uncertainty. On the other, you have historic network upgrades and the steady hand of institutional accumulation. The coming months will be a true test of conviction. They will determine whether this crash was the start of a long crypto winter or just the final violent shakeout before the next major bull run. What's your take? Is this the beginning of a long bear market for Ethereum, or is this the last great buying opportunity before the next surge? Let me know your price targets for the end of 2026 in the comments below. If you enjoyed this analysis, make sure you subscribe and hit that notification bell so you don't miss the next update. Thanks for watching, and as always, stay informed.